Hello guys, and glad to have you on board again today, talking about the breakout. This is one of the major patterns in the strategy, one of the things that can actually trigger quite some nice gains if you actually master the pattern. But once again, whatever can make money is not that easy. So breakout is something that I've seen multiple times in multiple courses from multiple coaches, some doing it much better than others, but of course a lot of bullshit around these things all over the web. So we're going to try settling into some solid stuff in here. What are the core information to succeed with breakout trading, how to improve your statistical behaviors, your emotional reactions to these patterns, and all of those things are what we're going to be talking about today. So what in terms of pro strategy is what I care about to build a reasonably probable trading breakout structure. Okay, so we're going to use a PowerPoint support because for technical reasons this is much easier for you guys to understand all the things at play on the pattern, and we're going to try settling for an example today. Let's get started. All right, so what you have in here, just like we do for every context analysis, we're going to start with the context paper that is on the PDF manual in here. So the breakout trade is situated in here. It is an intermediate level pattern, of course. It is following on from the accumulation trade and can happen just like we've seen on the accumulation trade, can happen in a trend following opportunity, which means previous trend were existing to the upside. We consolidate and we break to the upside again. Can also occur and validate reversals in which we go from a bullish trend or from bearish trend, we create a range, we accumulate eventually, and then we break on the opposite direction. So they can be trend following breakouts and trend reversal breakouts, depending on which direction the previous movement came from, okay? But in here, we're going to deal with them in the same way, okay? I think this is mostly about accumulation, that these directional move can matter and change the probabilities. But in here, we're not going to split that into two patterns because this is basically the same things that we've talked about for the accumulation. The odds for successful breakouts are just the same as odds for an accumulation to take place into one way or another, which means this is a 70, 30, 60, 40% approximate percentage-based reaction, which means there is a 70 to 60% probabilities in which a range that is preceded by an upside move will likely create an upside breakout. And there is a 30 to maximum 40% chances that a bearish move can create a reversal breakout. Okay, and therefore accumulating on the opposite direction before breaking it up. So we're going to deal with the breakout pattern in the same way. It's just that statistically speaking, as you've seen, normally probabilities to see on accumulations are less probable on the reversal patterns than they are into trend following. But this is not significant enough for you to just take this blind, stupid assessment that some traders do, in which trend is your friend, and if you came into a range to the upside, you'll likely get to the upside as well on the and keep on pushing. That's absolutely fucking false. Like I said, 30 or 40% chances for you to be wrong in this perspective. But still, if you always trade reverse and saying we've just gone up, we'll go down, that's of course less probable than the opposite. Okay, so just assess these probabilities, just bear them in mind and move on. Okay. So that's what matters. This is going to be another multi-time frame pattern, and in here we're going to use multiple time frames to either highlight targets or, more importantly, in here as the preparation part of the structure to define the tradable zone. We're going to make sure that there's enough room for a trend to emerge, because the problem is that, as you know, the strategy differentiates two stuff: the range breakout and the trend breakouts. And to make sure that we're actually talking about the one we care about today, the trend breakout, then you need to make sure that you have sufficient enough room to create a trend. Because if you're generally dealing with a higher time frame range, then fuck no, you're probably going to have a range breakout. Okay, so make sure there's enough room and that you're not trading into a higher time frame range. Otherwise, lots of troubles down the corner. Okay, what we look for in terms of reaction and price area is an area in which directional and volatile move will set, okay? And we break out of the mature range. It is absolutely necessary that you guys understand that. No mature range means no breakout, just like there is no accumulation into immature ranges. The second thing we're going to care about in here is that the thing that sometimes people tend to believe, Phil, there's no breakout because there's no accumulation. I mean, since when is there an if-then clause? It never happens that way. There is never 100% things that might or have to happen or whatever, okay? It's just accumulations are a definitely good element that will increase the probabilities for a breakout to be followed through. But there's many breakouts that occurs without accumulation or with a really teeny tiny accumulation, very volatile and stuff like that. So there are multiple ways trends can emerge and breakouts could emerge. Accumulating is one of them. It's the healthiest way of creating and forecasting a trend to emerge, but that's not a mandatory stuff, okay? So consider accumulation as being recommended, but definitely not mandatory. Some major catalysts can come up and alter the breakout structures and just create a breakout because something so big just emerged that why the fuck would we need to accumulate if there is a catalyst sufficient enough to push prices through the levels? We're definitely going to do it. That's not even talking about gapping structures and stuff that can just gap on top of the range and will create the breakout to emerge right after. There is also a second thing that you might be bearing in mind in here, and that is a serious thing that generally squeezes out the accumulation and goes right into breakout. It's the fact that we can have time frame trends, that we have trends on 2 time frames above. Okay, so consider that if you take a daily chart and if you have an ongoing trend on the monthly charts, then that means at some point investors might be willing to follow and trend follow that monthly stuff. Remember that this is one of the patterns we talked on the previous stuff. Anything that is 2 time frames away from the one you trade and specifically above, then it is going to be trend following. Okay, so if you are trend following a monthly pattern, a monthly trend with daily ranges, then any breakout is tradable and it doesn't require accumulation. Okay, but that is a specific case and we're going to talk about this one later on. What matters in here is that you understand that the breakout and the fact that we go on a directional and volatile move comes from the accumulation of technical clusters into a very teeny tiny area. Okay, so the thing is that we're generally going to accumulate a lot of stuff, just naming some of them: trend lines, cycles termination, third range boundaries, trend channel, context boundaries, all of those things. They generally tend to concentrate into an area. You basically see the mature range trend line heading into a direction. The third range boundary or horizontal level should definitely be into the same area normally, just like you would normally find your context boxes, and the trend channel should be right there as well when you get to reach out this area. And normally this is the fact that you reach out this area where there is a trend line, third range boundary, the context, the resistance, everything's just squeezed into a tiny area. You terminate a bullish cycle, and then instead of showing up the bears, bam, they just don't show up and the bulls break through. That's exactly what the breakout pattern is all about in terms of psychology. That doesn't mean the market is trending yet. It's just that means that normally the bears were supposed to trade there. There was significant enough information pointing to the interesting area out there, and just those who were supposed to trade on the opposite direction are not showing up. And therefore the opposite counterpart is just rapidly breaking, accelerating prices toward the next area, which is what we're going to be talking about next. Because what actually matters as you trade a breakout, and one of the common mistakes I see out there from either immature traders trying to trade breakout or stuff like that, is the fact that they lack of preparation and they lack of structure. Structure is what we're going to be talking about right after. But the preparation is key element, which means you need to make sure that there is a mature range. And the best case scenario is not just to try figuring this one out when the acceleration and directional move is setting in motion right now, but you must have some prior analysis, like if there's a mature range, how didn't you figure it out previously? So normally you should have figured out that range prior to that. You should have drawn the trend line. You should have waited for a possible accumulation and stuff like that. Be proactive. It's the best possible way you can trade a breakout, rather than showing up a chart because you see that the screeners have been highlighting this one because it has a significant amount of volatility today. I've seen so many people like so-called breakout trader, which is basically take the hot list and just have a look at the biggest day gainers and they say, oh man, this thing is breaking out, I'm getting in. They have absolutely no structure, no preparation, and just getting in there because it's the fancy stuff of the day. Let me be clear and honest with you guys. I've never seen any of those guys making money in the long run. I've seen many of them like boasting themselves on the social networks for nice gains, and then someday they just disappear. And I don't know, but I can tell that they probably just lost it all. So anyway, that's not how it goes, okay? So preparation is always necessary for breakout trading. Never trade with urgency or any stuff like that. You don't trade just because the price is changing pace. You trade because you prepared something, and you rather like to miss a trade rather than taking it under some emotional emergency, impatience, fear of uncertainty, biases, whatever, okay? So next, we take care of risk management. This is the second biggest mistakes coming from noobs or so-called breakout trader. They lack of consistency, they lack of structure. So you need a strategy for everything you trade, breakouts included. Like I said, it's not just breaking, it's not just price accelerating. There is a significant amount of preconditions required for a healthy breakout to take place. And more importantly, there's a way to risk manage into these patterns, because just like every other motherfucking pattern, you don't know for sure. And you're going to have to navigate between how much do I know and how much chaos can be happening out there. So the breakout, being the turning point between a range and a trend, should be this weird level in which we come from huge level of chaos, which is range trading, okay? In which the only safe island that we know about is the third range boundary. And we might be like trying to get out of here because afterwards we're going back to chaos and we would like to get a little bit of a safe island again. And trend is one of these, because by definition, when you're trending, means that you know that the prices will be higher later in time. So it feels like you control the future. Remember that we don't know shit. But trend is some kind of those safe island in which you don't know necessarily how the price structure will increase, but you just know prices will likely be higher a few candles away from now. That is a little bit of certainty into chaotic structure. So trends are by definition some kind of safe islands, okay? And therefore the switching point between chaos and safe island is always speculative. So the breakout isn't a certainty type of trade, and it comes with its own risk management. Okay, anyway, enough crap, let's talk about it. So the rules I've been I'm trading personally in terms of breakout, and just I could talk about it for an hour because there's really a lot of stuff going on in here that explains why I'm using this 1-to-1 ratio. But just to make it real simple, okay? When a smart money trader trades a breakout, like I said, compared to a noob who's going to say, all right, prices are moving up, I'm buying, whatever. A smart money manager will know that anyway, there's never 100% certainty. So we're going to have to risk manage, and we need to find some logical way to put it into motion into the market. And the first things we're going to do generally is that there is no one trading for less than a 1-to-1 ratio. A smart trader knows that anytime you trade less than 1-to-1, you're basically risking more than what you could gain. So this is why normally a smart money manager has lots of blocks and mandatory stuff that needs to be done before trading, and specifically this 1-to-1 ratio. So the smart money will actually target to get at least what it risks. Okay, and this is what this 1-to-1 ratio actually matters a lot for smart money managers. That means that wherever you're going to put the fucking stop loss, the first mandatory target for risk management is going to be this 1-to-1 ratio approximately. Don't considering it like a straight line that will be traded up to the point, but really something that is an area of interest in which smart money managers, instead of dumb traders, will generally risk manage their breakout trade, okay? Risk managing doesn't mean they're necessarily profit taking or whatever. That will depend on the signals you get out there, but that means something matters out there, okay? It's a speculative area, it's an area of interest, okay? So 1-to-1 ratio, if you get me right in here, you get it by highlighting the stop loss level, okay? And you double it to the upside, and it gives you the speculative area for smart money to risk manage their breakout trades, okay? So how do we put the stop loss? Okay, so the rule in here is going to be simple. If there is an accumulation, normally you're gonna put it into the lowest candle close on the accumulation time frame. Remember that accumulation is a range on the trend time frame, so you're gonna take the trend channels time frame, which is generally one time frame above the one you're looking at. If this is a daily chart, then the trend channel is a weekly stuff, okay? It updates each and every week, okay? So if that is a daily chart, and it actually is, that's the same example we've talked about for the accumulation trade. So here was your accumulation trade, by the way. Okay, you're gonna take the lowest weekly candle close within the accumulation. It's right here, okay? This is where you put the stop loss. So now that you know where the stop loss is put, okay, the lowest candle close, anyway, okay, you know the breakout level, okay? This is where, oh, sorry. This is where you break the cycles, this is where you break the trend lines, whatever, and you see the breakout candle, okay? Take this approximate level and measure this area and double it to the upside. You'll get a speculative 1-to-1 ratio area. This is where you validate, not just because, okay, if you get the psychology, that means normally if the smart money traded this level just like you do, they will risk manage in the same area that you probably will as well. So something will generally happen out there. If it doesn't, that means the smart money doesn't really care. Though either they didn't trade it, or they traded it and they're so confident that they're just not even profit taking. That happens, okay? That can happen when the smart money is so confident that the thing will skyrocket, they're just not even gonna risk manage. Because risk managing depends on the signals you'll get out there. If you've got some strong profit taking signals or whatever, I suggest at that point you risk manage by paying the stop loss, okay? But the number one mistake on the validation for this 1-to-1 ratio on the trend channels is generally people getting out too early. So either they're taking massive profits, like they're taking 75% profit. What's the fucking point? We're trend following. So the best case scenario out there, if you get me right, it's a 1-to-1 ratio. So if you actually want to pay for your stop loss, the best things you're going to be doing is taking 50% off the table. Okay, 1-to-1 ratio means you're paying half, you're taking half the position away and you paid for your stop loss. So if you really fear that there's going to be a hell of a pullback, then just pay for your stop loss and take 50% away, okay? But if you see absolutely no reasons to go bearish out there, what you're going to be doing is just basically, okay, eventually I'm not profit taking, or I'm just taking 25%, whatever, okay? That depends mostly on the risk management out there. You decide what you want to do. There is no mandatory rule. Each and every breakout is different because each and every breakout has different patterns that triggers, has different signals and stuff like that, different risk management, okay? But what you know for sure is that something must be done out of this 1-to-1 area. Either you see no reasons to do something and you do nothing just because you've seen that there was no reason to, or you see something that you have to do and you just do it. But make sure that you never take more than 50% of this trade. The profits risk-reward ratio for this trade comes from the fact that you let it ride as long as possible. And in order to have a trend that rides long enough, you need to make sure that you don't rise the stop loss too early, otherwise you're going to be stopped out anytime, every time. Or option number two, that you take too much profit in the process and therefore reducing the potential gains, okay? So maximum 50% profit taken in here. If you really fear for your stop loss, just pay for it and move on, okay? Second step comes from the range. Remember that accumulation and breakout must be preceded by a mature range on the context time frame, okay? So what you're going to be doing out there is you're going to do the same things as you did with the weekly candle close, but the higher time frame, 2 times above, daily chart, weekly, monthly, okay? So you're going to take the monthly closes, the lowest monthly close into the range, not into the range, but into the previous boundary, okay? So in here we do have this type of range, so we take the previous boundary and we take the lowest close it made. That's in here, okay? Though we do the same thing, we take that out of the breakout level and we double it to the upside, and you get the same 1-to-1 ratio, but this time onto the context time frames, okay? That is important you guys to understand. We do the same thing twice, on the trend channels time frame and on the context time frame, and there you get the validation level or confirmation, which are two absolutely very important levels for risk limiting and risk managing in breakouts. The first one is when you got the accumulation, okay? But when you're breaking without accumulation, then there is no validation level, okay? There's no trend preparation. So in that perspective, you will both validate and confirm with the context level, okay? So if there is no accumulation, if there is no mature range into the trend channel, then there will be no lower 1-to-1 ratio. You will validate and confirm right by the confirmation level, which is the same exercise but on the context time frame instead. Okay? When you reach out confirmation, the things you do is that at that point your trade is confirmed. God damn it, put the stop at break even and let it ride as long as possible. We'll profit take it at the pullback later on, which is the next trade we're going to be talking about. Okay? So when you get the breakout, when it succeeds, when it gets the validation and confirmation, or immediately both of them, just put the stop at break even and let the fucking thing ride as long as possible. Don't use trailing stop losses. I've seen so many traders using that shit. That's just as stupid as it is. No trailing stop losses. Put it at break even and let the fucking thing ride. I'll teach you where to profit take, okay? But that comes later on, okay? So the target for a nice and professional breakout trading is when there is a risk or when there is sufficient enough preparation to have an intermediate risk management, you can either do nothing or pay for your stop loss or make an intermediate profit taking, like a 25% profit that you will eventually get to reinvest, okay? That's a smart risk management. If you take, for example, 25% profit out of there, if you see that the market doesn't surrender and breaks it later on, you can put that 25% back in. It's just like if you feel that there are some risks, you can do a intermediate risk management out there, okay? And profit taking doesn't mean you cannot put the money back in later on. You can definitely do it. By the way, in this current example, you might have seen the breakout was a range breakout signal. So we got to the 1-to-1 ratio, created another accumulation basically, which is another mature range on the trend channel before actually breaking it. And that is, by the way, another pattern. Mature range pull backing to the third range boundary after releasing the 1-to-1 ratio. That is a trade I'll teach you to buy. So in here, for example, you would have 50% profit taking, pay for your stop loss, and you would definitely have put in another trade in here with more money in. And you will still have the breakout trade and the accumulation trade and the third range boundary pullback and all of those things. So all of this is just trades that will pile on top of each other and absolutely staggeringly increase the yieldings you'll make out of a trend. Not because you've taken a massive risk on a single position, but you've taken teeny little risks all across the globe and all across the trend emerged and created itself, and you will have plenty of intermediate reinforcements, like there would be another trade I'll teach you. All of those things comes later down the road, okay? But there are plenty of things we can do in a trend. What you need to understand is that you never take a big position. You never take too much risk into a single trade. You take tiny risks into some very, very precise speculative areas. The breakout is one of them. The way to manage a breakout is using this 1-to-1 ratio, not just because whatever, it's just because there is really a reason behind that. And I hope you do understand that. Okay? So there is a logical risk limitation, risk management, smart money way of behaving type of stuff out there. The second rule you need to absolutely be sure that you got out there is that you need to place the stop loss according to the accumulation time frame, the trend time frame. And if there is no accumulation, then the breakout is going to be riskier, though we're going to use a larger stop loss, and you're going to use the stop loss level into the context situation. So you're going to use the lowest context close preceding the breakout, okay? So if there's an accumulation, like I said, it's better. It's much better in terms of risk limitation, and therefore we're going to use a tighter stop loss, okay? Plus an intermediate risk management. If you do not have the luxury to have an accumulation preceding the breakout, you're going to have to deal with a context time frame only. That means a larger stop loss, though a tinier position sizing, and you will have no intermediate risk management. But still, the trade is probably still going to be profitable. It's just like, it's better when the accumulation is there, it's less riskier, but it doesn't mean it's mandatory. I hope you do understand this, okay? And yeah, of course, final stuff, absolutely mandatory, you need to understand, as long as the fucking stop loss is at break even, don't use the motherfucking trend following stuff, okay? Don't use the trending stop loss, trailing stop losses, okay? That's the stupidest things I've ever seen. Whoever's using a trailing stop loss, I've never seen a professional using a trailing stop loss. So you can do whatever the fuck you want, but I've only seen noobs using this thing. You better not to, okay? I'll teach you where to profit take, because that's mean you have a plan and you know the trend is reaching its end. But until then, just let it ride. And using trailing stop losses is just, well, I mean, if an external factor just shows up and fuck your stop loss, then that happens. That's chaos. And just don't blame the market. It will happen a little once in a while, but it is fairly reasonably less probable than just being stopped because of a trailing stop. Okay. Anyway, not moving the stop losses too fast. Let it ride as long as possible. That is key to success in risk management. For these trades, let's go conclusion. Okay, so summary out there. The breakout pattern isn't a complicated pattern. It just requires a little bit of preparation. But normally, if you've done it right, all of those things I've done before, which means you should figure out your range boundaries. But normally, as you already traded the third range boundary, you should already have drawn the horizontal level coming from this. If the range matured, riding its way to the fourth range boundary, and then you look for the accumulation, okay? And as long as you have 5 range boundaries plotted, then you should have 2 trend lines to frame your range. So at that point, the trend line from the range should be seen and visible. The third range boundary level should be visible as well. And then at that point, you look for the accumulation trade, which means this is the things we've talked about. So if you trade the accumulation, that means you've really well prepared for the breakout trade. And this is definitely the most comfortable solution to trade a breakout, to actually have managed your way into dealing with the range, seeing that the range matured, prepared for your accumulation, eventually traded it. And as you traded the accumulation, you know that by definition, the next step is probably going to be the breakout. So the only things you're going to wait for is for the prices to reach out to this very dense and concentrated area in which you have mature ranges on both trend channels and context channels. And all of these concentrated areas should definitely highlight a lot of trend line pointing to a same area. And what you're going to look for is the moment in which the cycles gets broken. And generally it happens right into this very dense and concentrated area. When you see this, either the algorithm's detecting it automatically, putting you either those square signals or cross signals, or sine wave just breaking itself. And if you have none of my indicators, then no problem. Sine waves indicators are sometimes available for free within the trading platforms. You will just have the raw sine wave, but what matters is that you breaking something, a cycle, okay? Normally that means that your opponents should be dealing with this area and they just don't. When this area breaks up, think about this 1-to-1 ratio, okay? And this 1-to-1 ratio doesn't exist just because of whatever. It exists because the smart money will risk manage out there, okay? So take this range as a reference point. Accumulation, then do it on the trend channel. No accumulation, wait for the context to do such a thing, okay? Don't forget that if you do not profit from these structures to risk manage your own trades, you're basically writing something you have absolutely no control above, and that is the less probable context to make gains in the market. You need to have a plan, you need to have a structure to risk manage, and if you do both, normally there's not even a chance you could lose money over multiple trades on those breakout trades. That doesn't mean the first one is not going to win. It just means the more you trade it that way, the more profitable it gets. These are really rewarding trades up to the conditions you really met, that you have preparation, structure, and you fulfill the 2 goals of a breakout trade, which is don't put the fucking stop loss at break even too soon. If you do it, you're destroying the possibility for your success in this trade. And secondly, if you are just using trailing stop losses, which will severely limit the gains. So let it ride and don't put the stop loss at break even too soon. These are the key elements. They will work around your impatience biases so much. So this trade will sometime, and for some people, reactivate some of your impatience biases and force you trading breakouts because you feel you're going to miss them, whatever. Okay, so manage this thing. If you lack preparation for a breakout, just don't take it, okay? Plenty of other trades, plenty of other opportunities. Just never rush a trade, and specifically not the breakouts. That being said, wish you guys a pleasant day. See you on the next one. We're going to talk about pullbacks eventually.